Okay. Good evening, everyone. Very good evening. How are we all? Perfectly fine. Yep. Okay. So I welcome you all once again to the follow-up session of today, which is on the topic of ratio analysis. And we have covered quite a good number of ratios in the last session. We have seen what is a current ratio, which is current assets upon current liabilities, for which the ideal ratio is 2:1. Then we have the liquid ratio, which is current assets minus stock minus prepaid expense upon current liabilities. Absolute liquid ratio, which comprise of cash and cash equivalents and marketable securities in the numerator, and current liabilities in the denominator. Okay. Then we have also seen what's the basic defense interval ratio, which tells us, for how long we are going to survive without any additional funding. And then we had some of the long-term solvency ratio also, which included equity ratio, debt equity ratio, proprietary ratio. And we also did an interesting aspect of gearing, wherein we said that it's good to, it's favorable to borrow if you are able to invest that borrowed money at a rate higher than the rate of interest. And also we have found that the rate of return which needs to be earned by all financiers, which is the return on capital employed, should be more than uh, which should be more than the rate of interest, right? So that will give superior returns to the equity shareholders. So we did also the capital gearing ratio in the subsequent part, right? So capital gearing ratio, which is debt plus preference share capital upon equity share capital plus reserves. Okay. So that was the set of ratios which we have looked at till the previous class. Now, in this session, we are going to understand some more ratios, and then we will be able to start with the questions. Okay. So, so next set of ratios, which are again a type of long-term solvency ratio, but which are which are going to be of use when it comes to measure the long-term solvency again, but this time the long-term solvency is not going to be measured by comparison between the debt and equity. Okay. So we are going to compare this by way of, we're going to compare, or we're going to we're going to look at the new set of ratios, which we are going to call as the coverage ratios. Okay. So let's try to look at what is this coverage ratio all about now. Okay, coverage ratios. So coverage ratios are going to tell us, they're going to give us an idea about the capability to pay interest or dividend, or you can say what is our capability to pay EMI. So coverage ratios are going to tell us how capable we are when it comes to payment of interest or dividend or EMI. Okay. Now, suppose we have two persons called as X and Y. Salary of X is 70,000. Salary of Y is 90,000. Whom do you think is more capable of paying EMI? Why? Well, you can't answer who is more capable of paying EMI because you need to know what is the amount of EMI. So let's say X has got an EMI of 30,000 and Y has got an EMI of 40,000. Now tell me, who is more capable of paying the EMI? Who is more capable of paying the EMI? Both are equally capable? Is it? Do you think both of them are equally capable? Yes. Do you think both of them are equally capable, or there is some sort of, point of debate which we can think of, which we can discuss of maybe? Well, you can't be saying both of them are equally capable because you need to see how much is your salary as compared to EMI. So if I ask you, how many times of EMI is salary? So what's going to be your answer? How many times of your EMI is going to be salary? How many times of EMI is salary? Can I say 70,000 divided by 30,000, which is 2.33, and over here it is 2.25. So of course, for every 1 rupee of EMI, X is having 2.33 as income. And for every 1 rupee of EMI, Y is having 2.25 as income. So marginally, slightly, we can say X is more capable, right? Or this is said to be like, for X, we can say salary covers 2.33 EMIs. Whereas for Y, the salary covers 2.25 EMIs. So X salary is enough to cover 2.33 EMIs and Y salary is enough to cover 2.25 EMIs. X has got a salary which is going to cover 2.33 EMIs and Y is going to have a salary which is going to cover 2.25 EMIs. So obvious that X is supposed to be more capable, right? So there are certain coverage ratio which is going to tell us this similar story. So if you want to see how capable the company is to pay interest, we say interest coverage ratio. Interest coverage ratio. Well, interest coverage ratio is EBIT upon interest. Right? So this is going to simply tell us EBIT is how many times of interest. So interest coverage ratio is going to tell us how many times of interest is the EBIT. Right? That's what interest coverage ratio. Same if you want to see preference dividend coverage ratio. Can anyone guess what could be the formula for this ratio? Preference dividend coverage ratio. Can anyone guess what would be the formula for preference dividend coverage ratio? Yeah. What do you think? Preference dividend coverage ratio. Well, preference dividend coverage ratio is calculated as PAT upon preference dividend because you need to have profit after tax to pay preference dividend, right? Okay. Then the next ratio is debt service coverage ratio. Debt service coverage ratio. This is going to be calculated as PAT upon, sorry, not PAT, my bad. Debt service coverage ratio. This is going to tell us, how capable the company is, to pay interest and principal due, right? So the formula that we have for debt service coverage ratio is, we write it as earnings available for debt service upon interest plus the preference interest plus the principal installment due. Earnings available for the debt service upon interest plus principal installment due. So debt service coverage ratio is earnings available for debt service upon interest plus principal installment due. Now, the question is, how do we calculate this earnings available for debt service? Okay, so let's try to understand this part. How to calculate the earnings available for debt service. Earnings available for debt service is calculated as profit after tax plus interest plus depreciation, or I can say plus all your non-cash expenses and plus non-recurring expense and further minus non-recurring income. So essentially this earnings for debt service, we can actually say this is representing sustainable future cash flows. So earnings available for debt service would be indicating the sustainable future cash flows. So which are the earnings that are available for debt service? It's going to be PAT plus interest plus depreciation or any other non-cash expenses. So we are essentially making it first before interest, because I want to see how much capable I am to pay interest. So I need to look at my income before interest. So before interest, what is your income? For that, you add the interest and then also adjust the non-cash and non-recurring items, because non-recurring items cannot be taken as a base for, calculating how capable you are to, when it comes to, payment of interest and principal. Right. So debt service coverage ratio is going to comprise of these things. So PAT plus interest plus non-cash expense plus non-recurring expense minus any non-recurring income. Okay. Now this is obviously would calculating this number, which is earnings available for debt service. It will require a detailed investigation of the financial statements. Debt service means servicing the debt. It means making the payment of the debt whenever and whatever amount is due. Like how capable you are to satisfy the debenture holders by way of payment of interest and principal amount. Okay, fine. Now, earnings available for debt service, calculating this particular part, it is something involve a detailed investigator into financial statements. You need to check out what are the expenses, which are the expenses and income, which are non-recurring, which are recurring. So that will require some good amount of time. But suppose you want to quickly just understand how capable the company is when it comes to interest and principal payment. So we can do a simple calculation by using this ratio called as fixed charges coverage ratio. Fixed charges coverage ratio. Fixed charges coverage ratio is EBIT, which is already a before interest number. We add depreciation to it, EBIT plus depreciation upon interest plus repayment of loan. Or basically the principal amount. So denominator is just one and the same, but the numerator is, bit simple, so that you can calculate this ratio quickly. And if you're not able to calculate, if you're not able to get the numbers appropriately for the debt service coverage ratio because of you don't have time to do that much investigation. So a quick way of understanding how the capable company is, that's going to be your fixed charges coverage ratio, which is EBIT plus depreciation upon interest plus principal. Okay, are we clear? Everyone? So these are the 4 coverage ratios which are quickly going to tell us how capable our company is when it comes to the repayment of principal, or whenever we talk of payment of any fixed nature that we have. Okay, fine. Let's go for the next ratios now, guys. Now we have some more interesting ratios which we are going to use to measure the activity, efficiency, performance, or turnover of the company. These all are called as activity or efficiency or performance or turnover ratios. Okay, so this is going to be there to measure how actively how actively company is utilizing its assets. So it's going to be like to measure how actively company is utilizing its assets. So we have S and P. Let's say there are 2 companies. The first company has an asset of 2 lakh. Second company is having asset of again the same 2,30,000. Okay. And let's say the sales generated by company S is 1 lakh. Let's say 12 lakh. And the sales generated by this company is, let's say, 13 lakhs. Now, can you tell me which of these 2 companies are utilizing their assets effectively or actively? Which of these 2 companies are utilizing their assets on a more active basis? Which company is utilizing its assets more actively? Yeah. Or I can simply say how many times of assets is the amount of sales. So we can simply say total assets. If it's 2 lakh and 2,30,000, sales is 12 lakh, 13 lakh. So we want to know how many times of assets is the amount of sales. How many times of asset is the amount of sales? Tell me this. Can I say the sale is 6 times that of assets when it comes to S, and for P, it is 5.65. So which company is actively more utilizing its assets? So S is generating sales 6 times its assets. So using 1 rupee asset to generate a sale of 6 rupee. And when it comes to company P, it is able to generate a sale of company P is able to generate a sale of 5.65. Company P is able to generate a sale of 5.65 uh, for every 1 rupee of asset. Of course, company S is more active. Company S is more active, and this is less active. Okay. So we have certain turnover ratios based on this thing. So first thing that we can have is, as we did over here, total asset turnover ratio. Total asset turnover ratio is sales or COGS divided by average total assets. So sales or COGS divided by average total assets. Same way, if I want to see the fixed assets turnover, can you tell me what will be the formula? If I want to see how effectively we are utilizing the fixed assets, how effectively we're going to utilize the fixed assets, how effectively we are going to utilize the fixed assets. Sales upon, or it's going to be sales or COGS, depending on whatever information is given to us. Sales or COGS upon average fixed assets. Right? Sales or COGS upon average fixed assets. That's your fixed asset turnover ratio. Okay. Average means basically opening and closing, because every total assets or total of fixed assets, that will vary, right? Opening value and ending value, closing value, opening value will be different. So we will take the average of both opening and closing. Okay. Fine. Now, same way, if I want to see how effectively we are utilizing the money that is invested. So efficiency of the capital that is employed. So you'll say total capital employed turnover. Total capital employed turnover is simply total capital employed upon, sales or COGS upon average total capital employed. Sales or COGS upon average total capital employed. That's a total capital employed turnover. Same way, if you want to say how effectively you are utilizing current assets turnover, current assets, so that's going to be also same. Sales or COGS upon average current assets. So if I ask you what will be the working capital turnover, working capital turnover, sales or COGS divided by average working capital, right? So if I want you to tell me like any turnover ratio, a general form of any turnover ratio, X turnover. The general form is simply sales or COGS upon average X. Sales or COGS upon average X. Right? So all these turnover ratios are going to have this simple format. Okay. Now, but apart from the normal turnover ratios that we have a standard format, which is sales or COGS upon average X, a very crucial set of ratios that we need to look at is, specifically, it's related to the working capital ratio. That's going to be very specific. So working capital ratios we need to be very crucial or critical about when it comes to any of these numbers. So let's try to understand them. We'll first discuss about something called as inventory turnover ratio. Right. So let's try to understand this. Two companies, let's say E and F, they're having a COGS. E is having a COGS of, let's say, 9 lakh. F is having a COGS of 10 lakh. So E is having a COGS of 9 lakh. F is having a COGS of 10 lakh. And the average stock or average inventory. So company E maintains the average inventory of 3 lakh. Company F maintains the average inventory of 2,50,000. Okay. So now my question is, how many times of stock is the COGS? How many times of the stock is COGS? Yeah. Or to put it in a more simpler way, I would like to say how many times stock is sold in a year. How many times stock is sold in a year? So what is the number of times in which a stock is sold? So we can say it is, of course, 9 lakh divided by 3 lakh. It is 3 times and 4 times. Right? So we are able to sell this stock 3 times. In case of company E, we're able to sell the stock 3 times. And in case of company F, we are able to sell the stock 4 times in a year. Right? Or to put it simple, like using 1 rupee of stock, the company is able to generate 3 rupees of sale. And with rupees 1 of stock, company F is able to sell 4 rupees of sale, or company F is able to generate 4 rupee of COGS. So if I ask you which company is more active, when it comes to utilization of inventory, active use of inventory is being performed by which company? Which company is having a more higher level of activity when it comes to use of inventory? Which company uses the inventory in a more active way? Yeah. Which company is more active? Of course, it is company F. This is more active and this is less active because you are able to generate 4 rupee sale with 1 rupee stock, right? Okay. ₹4 of stock. Right? The company F is going to have 4 rupee of stock against, 4 rupee of COGS against 1 rupee of stock. So of course, company F is, doing the task in a more active way. Now, an interesting question to you guys. Can you tell me what is the number of months required to sell one lot of number of months required to sell one lot of inventory? Which E or F? Just try to tell me how many number of months will you need to sell one lot of inventory? Number of months required to sell one lot of inventory. Well, when it comes to company E, the number of months that will be needed, like in a year, you're selling 3 times. In 1 year, you're selling 3 times, right? So every four months, can I say the inventory is being sold? Right? So this is going to be number of months which is required to be sold. 12 divided by inventory turnover. So it's going to be 12 divided by the inventory turnover number, which is 3. And here we have this as the months. Number of months required to sell one lot of inventory is 4 months in case of company E and 3 months in case of company F. So number of months which is required to sell one lot of inventory. In case of company E, it is 4 months. And in case of company F, it is going to be 3 months. And this is what we call it as inventory holding period. This is what we call it as the inventory holding period. Okay. So we can say inventory turnover ratio. Inventory turnover ratio. It's going to be COGS upon average stock. Inventory turnover ratio is going to be COGS upon average stock. And inventory holding period, it's going to be 12 or 365 or 52 divided by inventory turnover ratio. So inventory turnover is COGS upon average stock. Inventory holding period is 12 or 365 or 52 by inventory turnover. And this simple implication is, if you have a high inventory turnover ratio, that simply means you're having low inventory holding period. High inventory turnover ratio is going to be equal to low inventory holding period. So high inventory turnover ratio is going to be equal to low inventory holding period. Okay, inventory turnover ratio is going to be COGS upon average stock. Inventory holding period is 12 or 365 or 52. That's going to be high inventory turnover ratio. It means it's going to imply low inventory holding period. Okay. Now, the next two ratios are going to be pretty simple because we are going to talk of debtors turnover ratio. So debtors turnover ratio is credit sales upon average receivables. And remember over here, receivables will include bills receivables. Creditors turnover ratio is going to be equal to credit purchases divided by average payables. And remember, the payables will include bills payables. Okay. Now, just like you have the debtors, inventory holding period, same way we may have the receivables or debtors collection period. So debtors collection period is going to be 12 or 365 or 52 divided by debtors turnover. 12 or 365 or 52 divided by debtors turnover. Same way, can you tell me what will be the creditors payment period? What will be the creditors payment period formula? Yes, guys. Can you tell me what will be the creditors payment period formula? What will be the creditors payment period formula? Creditors payment period formula. Yes. It's going to be 12 or 365 or 52 divided by creditors turnover. 12 or 365 or 52 divided by creditors turnover. Okay. 12 or 365 or 52 divided by creditors turnover. Right. That's your creditors turnover ratio. Fine. So these were the activity or efficiency turnover ratios. Okay. Now let us go for the next set of ratios, which are very simple, because we are going to look at what are the profitability or profit and loss statement ratio. Profit and loss ratios. All these ratios are going to be of the simple format X upon net sales multiplied by 100. X upon net sales multiplied by 100. So profit and loss ratios will comprise of X upon net sales into 100. That's your P&L ratio. So if you want, let's say gross profit ratio. Gross profit ratio. Gross profit ratio will be what? Gross profit upon net sales multiplied by 100. Net profit ratio will be net profit upon net sales by 100. Right? Now, what will be net profit? Net profit will be PAT or PBT. If it is after tax, it will be PAT. If it is before tax, then it's going to be profit before tax. Okay. Operating profit ratio. Operating profit ratio. Can anyone tell what will be the formula for this? Operating profit ratio. Anyone? What will be operating profit ratio? Operating profit ratio is what will be operating profit ratio? What will be operating profit ratio? Okay, operating profit upon sales, but then talking of what is uh, operating profit as such number. Yes, operating profit ratio. Well, operating profit ratio will definitely say operating profit upon net sales, but operating profit is EBIT upon net sales into 100. So operating profit ratio is, this is EBIT upon net sales into 100. COGS ratio is COGS upon net sales multiplied by 100. COGS upon net sales multiplied by 100. All right. So these are some of the ratios that we have. Now, operating expense ratio. Operating expense ratio will comprise of your admin plus selling and distribution expense divided by net sales into 100. Okay. Then we have something called as operating ratio. Now, what is operating ratio? Operating ratio is COGS plus operating expense upon net sales into 100. So operating ratio, when we say COGS, it considers COGS also as an operating expense. Okay, so operating ratio, we can say it is COGS plus operating expense upon net sales. So which is, we can understand this simply as what percentage of sales is spent on operating the business. What percentage of sales is spent on operating the business? Okay, so that's your operating ratio, correct? That's your operating ratio, guys. So these are some of the P&L ratios that we have, guys. Now we have to look at certain really interesting set of ratios called as a market ratios. Market ratios. So for that, let's try to understand this market ratios with the help of two companies, A and B. Let's say they have net profit for equity shareholders. Company A is having a net profit for equity shareholders, let's say 2,40,000, and that for B, it is 3 lakh. Now, which of these two companies have generated good profit for their shareholders? Vedant is asking, will you upload these ratios at US? Yes, I will be once the chapter is done. Once the chapter is done, I'll be uploading this notes. So what is net profit for equity shareholders? If a net profit for equity shareholders is 2,40,000 and 3 lakh, which of these two companies do you feel have done, better, have generated better return or better returns for its equity shareholders? B. We can't be looking at that number and saying, because I need to also see what is the number of equity shares. So let's say the number of equity shares over here is 80,000 and here it is 1,20,000. The number of equity shares 80,000 and 1,20,000. Then tell me which of these two companies have generated good returns. Which of these companies have generated good returns is? Which of these companies have generated good returns? Is it company A or company B? So for that, we need to actually calculate the earnings per share. Well, the earnings per share is going to be net profit for equity shares divided by the number of equity shares, which is 3. And here it is 2.5. So of course, it's company A which has done good job, right? So this is our formula for the first one, which is earnings per share. So earnings per share is net profit for equity shareholders divided by number of equity shares. Net profit for equity shareholders divided by the number of equity shares. That's your earnings per share. Okay. Let's say dividend paid by company A is 50,000 and company B it is 1 lakh. Can you calculate what is the amount of dividend which company has paid for each of its shares? Or can we calculate the dividend per share? What will be the dividend per share number wise? Yeah, dividend per share. Well, guys, the dividend per share is dividend divided by number of equity shares. So dividend divided by number of equity shares. 0.625 and 0.8333. That's your dividend per share. Okay. Okay. Now, if I ask you, what is the dividend payout ratio? Or I'm asking you like, what is the proportion of earnings paid as dividend? So what is the proportion of earnings that the company A has paid? How much proportion of its earnings company A has paid as dividend? How much proportion of earnings has company A paid as dividend? Yeah. Why it is divided by EPS? Where is it? DPS is calculated by dividing with the number of equity shares, not EPS. Yeah, guys. So what proportion have the company paid? Like company earned, so this is going to be dividend payout. The dividend payout, we can say you're paying out 0.625, you're paying out 0.625 against an EPS of 3. So company has earned 3 rupee, but it is paying out 0.625. So of course the proportion stands as what? 0.20833 and this is 0.333. So if I ask you which company has paid a better proportion, which company has paid a larger proportion of its profits as dividend? Company B, right? It's going to be company B. So dividend payout is going to be 0.3333. That's your dividend payout. So dividend payout ratio, the formula is DPS upon EPS. And then if I ask you retention ratio is proportion of earnings retained by company. Proportion of earnings retained by company. So retention ratio, which is simply going to be, guys, 1 minus dividend payout ratio. Whatever is your dividend payout, just do 1 minus with that. So it's like if you're paying out 20% as dividend, of course, the rest 80% is retained. Okay, fine. So that's your retention ratio. Then let us say market price per share. Market price for this company is 12 and for this company is, let's say, 18. So if I ask you, what is the dividend yield? So dividend yield is simply going to be what dividend you have paid on the basis of your market price. So your DPS is 0.625, your MPS is 12, market price is 12. So dividend per share is 0.83 and then market price is 18. So by paying 18 rupees, you're earning a dividend of 0.625. And then paying 18 rupees, so by paying 12 rupees, you're earning a dividend of 0.625. And by paying a MPS of 18 rupees, you're getting a dividend of 0.8333. So what will be the dividend yield ratio, guys? What will be the dividend yield? What will be the dividend yield? Dividend yield will be EPS divided by 12. So we are essentially earning what, 5.21% in company A and 4.63% in company B. Okay. Got it, guys? The dividend yield is 5.21% and 4.63%. Same way, if I ask you what is the earnings yield will be EPS upon MPS in 200. So earnings yield is EPS upon MPS into 100. Earnings yield is going to be 3 divided by 12. And same way over here, 13.89%. So when it comes to yield basis, we can say that the company A has generated good returns for its equity shareholders. Whereas when it comes to dividend payment, there also company A has given good dividend, but per share basis, you can say it's company B which has given better. But obviously, the share price of company B is also on a higher end. So when you ultimately boil down to the return percentage, that's going to be comparatively lower. Okay. Okay, guys. Yeah. Right. So that's your dividend yield and earnings yield. So these were some of the market ratios that we are talking of when we want to measure the performance of the company from a market price or from the overall market performance perspective. So it will include your EPS, dividend per share, your dividend payout, earnings yield, and all those aspects are considered over here. Okay, fine. The one ratio that's very crucial and that's really important that we need to check out over here is something called as P ratio, price to earning ratio. Okay, before we understand this ratio, let me just take an example. Suppose you have two products X and Y, not company products. When it comes to features, you'll say both of them are having same features. Right? For example, let's say we're talking of comparing two phones. Two phones are having same features. What do you expect the price for those two phones to be? If two phones are having same features, what do you expect uh, expect the price to be? Maybe similar, right? Maybe similar. Let me just turn the table. Let me say this is Redmi and this is Apple. Same features, same quality of camera, same battery life, same screen, camera quality, processor, everything is same. Features are very much same. What do you think about the price that they will command? What do you think the price they're going to command? Do you think they will be having the same price now? I have written the name of the phones of the company. One is your Redmi, another is your Apple. Of course, the price is going to be low over here, price is high over here. Now, quite obvious that Apple is going to command a higher price. Apple is going to command a price which is comparatively very high. Now, why is it that really going to happen? Why is it that Apple is going to command a higher price? Because price actually depends on confidence of the buyer. Here the confidence is low and here the confidence is high. Right? So people are ready to pay a higher price when they have a greater confidence. Now let me just change this. And let's say two companies now, X and Y. Instead of features, I say EPS. EPS is, let's say, 12 in both cases. Okay. But company X is trading at a price of 120. Company Y is trading at a price of, let's say, 96. Now tell me, which of these two companies do you feel have got a greater degree of confidence? Which of these two do you think? Yes, which company is having a greater confidence of the investors? Yes. Which of these two companies enjoy greater confidence? X, Y, XS. Well, let's try to calculate one ratio called as price to EPS or MPS upon EPS. So this is what? 120 divided by 12, 10, and this is 8. So for company X, people are ready to pay 10 times its earnings. And for company Y, people are ready to pay 8 times its earnings. So of course, confidence, when we say here the confidence is high and here the confidence is low, guys. So X has got a greater confidence because it is commanding a higher price as compared to its earnings. So price to earning ratio is NPS upon EPS, and this is going to tell you how confident the shareholders are when it comes to the company. Okay, so finally we say company X is having a greater degree of confidence, guys. Okay. Now one more ratio before we go for the start of the questions is that equity shareholders funds. We calculate the equity shareholders funds as what? Equity share capital plus reserves, right? And this is what we call as also as the book value of company, right? So let's say the book value of company is 30 lakhs. Okay. So if I ask you what is book value per share, that's going to be obviously equity shareholders funds divided by number of equity shares. So book value per share is going to be equity shareholders funds divided by the number of equity shares. So equity shareholders funds is going to be 30 lakhs divided by number of equity shares is, let's say, 1 lakh. So we get book value per share as 30 lakh divided by 1 lakh, which is 30. So book value per share is 30 and market price per share let's say the market price is 36. So in our books, the value of company is 30, whereas the market price, in market, the share price is 36, right? So if I ask you, what is market value to book value per share? Obviously, it is going to be 36 divided by 30, which is simply going to be like 36 upon 30 as the market value to book value per share, 36 to 30, which simply means for every rupee 1 of, for every rupee 1 of the book value to market value to book value per share, we say it is 36 upon 30 or 1.2. So it is simply meaning for every 1 rupee of book value, market price per share is 1.2. Or I can say market price is 1.2 times of book value. Market price per share is 1.2 times of book value. Okay, so that's your market value to book value per share, which is 1.2. So market value to book value per share, we say it is 1.2. That's your this particular ratio. That's your market value to book value per share. One more ratio, which is rarely used, but still is called as a Q ratio. Q ratio is market value of the company and divided it by replacement cost of assets of company. So it is like, suppose the market value is, in our case, as we said, it is 36 lakh. And suppose we want to create a similar company now, and I need to get these assets which we have in the market in the company now. So we find that it's going to be 33 lakhs, let's say. Just an example. So we get this number as 1.09. So this simply means so 1.0909, that's going to be this particular number, which is 36 lakh upon 33 lakh. So 36 lakh divided by 33 lakh. This simply means that market value of company is 1.09 times of its replacement value. Right? So it means if I want to create a similar company, I need to spend 1 rupee for it. But if I want to buy the similar company from the market, I need to pay 1.09. So basically, the company is commanding a 9% premium over its replacement value. Okay. What's the Q meaning? Q is just a variable given to this ratio, just like you have a pi, right? Just like you have a pi or you have a theta. Same way, these are the variable. These are number or a variable which has been given. Okay. So that's your Q ratio, which tells us what should be the replacement, what should the market value in comparison with the replacement cost of the assets of the company. Okay, fine. So with that, we are through the ratios. Okay, we are through the ratios in this chapter. Now we have to do a good quantum of numbers or good quantum of questions in this case. Okay. So let's just take a break, and then after the break, we will start with the questions on this topic of ratio analysis. Okay. Let's take a break, guys. Are we all there? Everyone? Are we all there, guys? Yes. Have you all returned from the break? Please confirm it before we start with the questions. Are you all back, everyone? Yes. Okay, so let us go for the next section of this chapter, wherein we are going to solve the questions, practical problems. Let's have a quick look at it. Going to have some interesting questions, which we will be, covering it. So let's get started with this question number 1 is. Can we see the question? Can you see the question, guys? Yep. Can you see the question? Okay, so following is the balance sheet of Z Limited as on 31st March 2003 and other information. Calculate the following ratios. So first thing is current ratio, then you have liquid ratio, stock working capital ratio, capital gearing ratio, stock turnover ratio, debtors turnover ratio, and collection period. Okay, and then we have the opening stock as 1,20,000, sales, which is all credit sales on 20 lakh, gross profit on sales is 25%, debtors as on 1/4/2002 is 40,000, which is your opening debtors, right? And then we have on the liabilities and asset side of balance sheet, right? So we have to compute certain numbers from this. So let me just take this question and place it over here. Okay. Let's get started, guys. Following is the balance sheet given to us. We have like the balance sheet numbers and everything is given. We have to compute the current ratio. So let's try to first get the current ratio answer. Current ratio. What was the formula for current ratio, guys? Formula for current ratio. What's the formula for current ratio? Yep, current assets upon current liabilities. Perfect. So we have the formula for current ratio available with us, which is current assets upon current liabilities current assets upon current liabilities. Current assets upon current liabilities. So current assets is going to comprise of 3,80,000 of stock plus 3,60,000 of debtors plus prepaid expense of 60,000, and then divided by the current liabilities. So the current liabilities comprise of only two aspects, which is your creditor and bank overdraft. So this is going to be creditor of 3,20,000 and bank overdraft of 80,000. So how much is this? And of course, yeah, one more thing in the current assets, guys, short-term investments of 2 lakh. Okay, so what is going to be this current ratio? What's going to be the current ratio? What's going to be the current ratio, guys? Current ratio 2.5. Okay. Current ratio is 2.5. Then next ratio is liquid ratio, guys. What's the formula for liquid ratio? Formula for liquid ratio. Formula for liquid ratio. Liquid assets. So liquid assets will comprise of current assets minus certain assets. So certain current assets are not liquid. Which are those two assets which are not liquid? In fact, we'll just consider, we can put it in the other way around. Instead of current assets, we can simply say liquid assets. So liquid assets will be liquid assets upon current liabilities. So liquid assets will be liquid assets is going to comprise your short-term investments of 2 lakh plus debtor of 3,60,000 and no, stock and prepaid expense won't come over here. So we just have the liquid assets as 2 lakh and 3,60,000, and then current liabilities remain the same, which is 3,20,000 plus 80,000. So what's the liquid ratio, guys? What's the liquid ratio? 1.4. Okay, great. Now, next is stock working capital. Stock working capital ratio. Now, stock working capital ratio. How do we get this stock working capital? It is going to be stock upon working capital. So we have the stock value as 3,80,000. Stock is 3,80,000 upon working capital, which is current assets minus current liabilities. So how much is the total current assets? Total current assets. Or you can do simply one thing as its current assets is 2, 380, 360, and 60. Total current assets is 10 lakh and current liabilities are totaling to 4 lakh, right? So 10 lakh and minus 10 lakh minus 4 lakh. So we have this as 10 lakh minus 4 lakh. So 3,80,000 divided by 6 lakh. So stock to working capital. How much is this proportion? 0.63. Okay. Okay. Now capital gearing ratio. Capital gearing ratio, we know debt plus preference share capital in the numerator. Debt plus preference share capital divided by equity shareholders fund. So debt plus preference share capital, debt will comprise of 1,60,000 and preference share capital is 3 lakh. We divide it by equity shareholders fund, which will be 6,40,000 of share capital. 6,40,000 of share capital plus 60,000 plus 2 lakh. 60,000 plus 2 lakh plus 20,000 of P&L. So how much is capital gearing ratio? How much is the capital gearing ratio is? 0.5. That's 0.5. Okay, so capital gearing ratio is done. Then we have stock turnover ratio. How do you calculate the stock turnover ratio? Stock turnover ratio. Stock turnover ratio. Stock open turnover. Oh, stock turnover ratio was COGS upon average stock or inventory turnover ratio. Right. So we have the COGS number. COGS is like we have the sales figure 20 lakh, of which GP is 25%. So COGS is going to be sales of 20 lakh. 20 lakh minus on this 20 lakh, you subtract the gross profit. Because the gross profit is 25%. This is your COGS. And then you have the average stock. Now the average stock will be average of opening and closing. So opening is 1,20,000. And closing is 3,80,000. This divided by 2. So how much is the stock turnover? 6 times. Okay, fine. Stock turnover is 6 times, and then after that you have the debtors turnover ratio and collection period. So we have the debtors turnover. So how do we calculate the debtors turnover? Debtors turnover is credit sales, right? Because everything is on credit anyways. Credit sales upon average debtors or average receivables. So credit sales is fully, it is 20 lakh upon average debtors. What's the value of average debtors? Debtors is, we have the debtor value as 360 and 40. So average is what? 2 lakh. So average is 2 lakh. So debtors turnover is going to be 10 times. Okay, and then we also have the collection period. Debtors collection period. So collection period will be um, nothing has been specified with regards to number of days, or we can, since it is 10 times, I can say it is 365 upon 10, which is 36.5 days. Because in a year, you are having a turnover of, in a year, you're having a turnover of 10 times. So obviously each cycle is going to be having 365, 36.5 days. Okay, done guys? Fine. Are we clear how to calculate the ratios? Okay, fine. Now I just want you to try out this question number 2. Try out this question number 2, guys. Would you like to give it a try and then I will solve, or you just want me to solve it? Will you try it? Then I will give the solution, or do you want me to solve directly? Guys, we'll try. Perfect. Go ahead, guys, give it a try. Go ahead, give it a try. Question number 2. Are we done? Question 2 is, yep. From the following information, ascertain the long-term loans, reserves and surplus, and capital employed. So capital gearing ratio 0.75, debt equity ratio 0.4, long-term debt to shareholders funds. This is what they have given us as the ratio. Equity share capital 3 lakh, preference share capital 1 lakh. So let me just copy this question and then we'll solve it over here. Yeah. So first up, we have the capital gearing ratio and debt equity ratio. We don't know what is the long-term loan and reserves and surplus. So let's say, let long-term debt be rupees X and reserves be rupees Y. So capital gearing ratio. Capital gearing ratio. We know it is calculated as capital gearing ratio is what? Preference share capital plus long-term debt upon equity share capital plus reserves. You know the preference share capital is 1 lakh. Long-term debt we don't know. Let's take it as X upon equity share capital is 3 lakh plus reserves is something that we don't know, which is Y, and then the capital gearing ratio is 0.75. Then we have the debt equity ratio. So debt equity ratio is long-term debt to shareholders fund. Here they're clearly stating it is long-term debt to shareholders fund. So long-term debt to shareholder fund means preference share capital plus equity share capital plus reserves. So long-term debt is X, preference share capital is 1 lakh plus equity share capital is 3 lakh and reserves is Y, and this is going to be 0.4. Right, so this works out to be what? X is equal to X equal to, but I'll say is as X upon 4 lakh plus Y is equal to 0.4. So we have two equations. One says it is 1 lakh plus X upon 3 lakh plus Y is equal to 0.75. Then we have 1 lakh plus X is 0.75 into 3 lakh. So 0.75 into 3 lakh is 2,25,000 plus 0.75Y. Okay, let's keep all variables on one side. So X minus 0.75Y is 1,25,000. And the next equation is X is equal to 4 lakh into 0.4, which is 1,60,000 plus 0.4Y. So you have this as X minus 0.4Y is 1,60,000. So this is equation number 2. Then we have X minus 0.75Y is equal to 1,25,000, which is equation number 1. Now, when we have both the things over here, both the equations, can we solve simultaneously and get the value of X and Y? So solve both the equations 1 and 2 simultaneously and give us the value of X and Y, guys. Yes, what's the value of X and Y? Perfect. So X is 2 lakh and Y is 1 lakh. Is it? 2 lakh minus 0.75 and then 2 lakh minus, yeah, perfect. So X is 2 lakh and Y is 1 lakh, which is, long-term debt and reserves. Okay, so that's your question number 2. Fine. Then question 3. Will you try it or shall I solve guys? Question number 3. Look at question number 3. Will you try it? Question 3. Yeah. Okay, go ahead guys. Go ahead. Okay, let's try to solve this. So we have the average inventory as 3 lakh 60 and inventory turnover is 6. So inventory turnover is 6. So this means it is COGS upon average inventory. Okay. So we have 6 is equal to COGS divided by average inventory is 3 lakh 60,000. So what will be the COGS value? COGS value. If average inventory is 3 lakh 60, what will be the COGS value is? Yeah, 21 lakh 60,000, right? 21 lakh 60,000. That's your COGS. Yeah, so COGS is 21 lakh 60,000. But then we have a gross profit ratio as 10%. Gross profit ratio is 10%. So we look at GP ratio. GP ratio is 10%. So can I say COGS will be 90%. So sales value is going to be 21 lakh 60,000 divided by 90%, which is COGS divided by 90%. So what is this number then? 21 lakh 60,000 divided by 90%. Yep. 24 lakh. Sales is 24 lakh. Yes. Okay. Sales is 24 lakhs. Okay. So we want the average collection period and frequency of turnover. But remember, we have to take the credit sales value. The credit sales to total sales is 20 lakh. So I need to first get the value of credit sales. So how much is credit sales, guys? Credit sales is 24 lakh into 20%, which is 4 lakh 80,000. Credit sales is 4 lakh 80,000, guys, right? Credit sales 4 lakh 80,000. And then we have the debtors value also as 2 lakh 30. Debtors is 2 lakh 30,000. Credit sales is 4 lakh 80, since it is 20% of the sale. And then we have the debtors as 2 lakh 30,000. So what will be the debtors turnover, guys? What will be the value of debtors turnover ratio? How much is debtors turnover going to be? Debtors turnover. Yeah, credit sales 4 lakh 80. What is the debtors turnover? Debtors turnover is what? Credit sales upon debtors, which is 4 lakh 80,000 divided by 2 lakh 30,000. How much is this debtors turnover ratio? How much is this? 2.086 or 2.087. Okay, then the question is, you have to compute the average collection period. So, debtors collection period. The formula for debtors collection period, it is 360 upon debtors turnover. So that's 360 divided by 2.087. So how much is 360 divided by 2.087? 360 divided by 2.087. Yes, how much is it? 172.49? 172.49. Or I can just round it up to 173 days. Okay. Okay, 173 days. Fine. So with that, we are done with this question number 3, guys. So the remaining questions from this worksheet, we will take up in the next upcoming session. Okay, so with that, let's just call it a day today. Right. Thank you for giving me a patient hearing. And take care, guys. Bye-bye.
Recording stopped.